Welcome to the PIWORLD webinar on Thursday, 30th of April, and I'm your host, Tamsin Freeman. Today, I'm delighted to be joined by financial pundit David Buik for a macro market commentary. David, many thanks for joining us. Tell us a little bit about your background.
First and foremost, saying it's a great pleasure to be with you, Tamsin, and all your listeners as well. I suppose that I probably was the deepest disappointment to my father, who gave me a splendid education. I didn't pass a single exam, and he told me over a very angry lunch at Gow's one day that I was a disgrace. He wanted me to be a corporate lawyer, but I'd have to settle for merchant banking. Of course, laughable today, but I started my life off at Philip Hill Higgins and Erlangers, which went into, of course, to Hill Samuel, which was one of the leading issuing houses of the day at the time. And I think probably in the 5 years I spent there, I learned more than in the other 52 years I've been in business. It was an incredible ground, but it wasn't for me. It wasn't exciting enough. So I went off into the world of money broking, and I started off with the oldest company in the market at that time. It was a company called R.P. Martin. I thought they were dead from the neck upwards, so I left them. And we set up a couple of smaller firms and eventually ended up working for Exco International for John Gunn and for John Morton on a localized basis, who was the chief executive of Godsall's. And the Godsall's and Astley and Pierce were the two companies that went to make Exco. And I was there for quite a number of years and eventually left again and ended up really as part of the Prebon Yamani group. And I spent my final years in money broking in Tokyo, where I spent a year, where I was summarily fired for not remembering that you are only allowed to show due deference to the management. You cannot tell them that they've got their situation wrong. And I was sent home within a week. And then I arrived home and I went into the world of money broking, into the world of spread betting, courtesy of Michael Spence, who offered me a job at an extremely average salary, but he did me a great favor. And I moved on to Cantor Index, or to Cantor Fitzgerald as it was then, and then became BGC Partners. And I was there for 15 years and have spent the last couple of years at Panmure Gordon. And I'm now working for one of my oldest friends in the City of London, Alistair Haynes, who is chief executive of a company called Aquis Exchange, which is an online exchange, basically doing more in the world of stocks and shares on a global basis than other markets. And I'm having enormous fun.
Fantastic. So you've worked through quite a few bear markets. How do you think this one compares?
It's got to be the worst by a country mile. Let's go through why. If you go back to 1987, which is probably the first one, through really at that time was what I would describe as the trashed bond market, junk bonds, the Michael Milkinses, the Drexel Burnham Lamberts and all those sort of things. And the market fell out of bed because assets were hopelessly overpriced as a result of that. Market crashed about 30% in 3 days right across the world. And we really thought, my gracious me. But you knew that was a way overdue correction. It did destroy a lot of financial people or financial boffins at the time, but it shook the trees and it had done really well. Before that, in 1974, when the worst Chancellor of the Exchequer this country's ever had, Anthony Barber, just ruined the economy, and Edward Heath took on the miners, and we were in 3-day lockdown, and it was pretty ghastly. And of course, we ended up going back to Labour and being in the International Monetary Fund, and things got very bad then. But then, of course, the 87 crash, and then, of course, we got the exuberance one from Alan Greenspan, and that, I think, if my memory serves me right, was in 98, which was over the Russian credit crisis. And so we've had a few, and then, of course, you could always see that what they call the TNT, which happened in 1999 when the tech market, the Neue market in Germany and the NASDAQ in the United States, and we started to get hold of it a little bit with companies like FreeServe, and then all the telecom companies, the Vodafones, the BTs did incredibly well, and the media companies like Sky and Pearson were way, way overvalued. And when we got to the FTSE in January, I think it was 6,940 or something of that order, and it just precipitously came down. Everybody thought this bubble is going to burst. And of course, then it eased in to the Iraq war in March 2003. And the FTSE, I think if my memory serves me right, was down to about 3,800. So that was a pretty big drop, but it was quite steady. over a period of 18 months. You actually knew it was going to happen. And then the banking crisis was horrendous. Okay, so everybody said it was precipitated by, the subprime lending in the United States. HSBC had flagged this up, funnily enough, in as early as 2006, when they bought this company Household for $14 billion and said it looks like a pup to us. And unfortunately, soft regulation was the case all over the world. So the United States suffered terribly at the hands of the banking crisis and the credit crisis. No question of any doubt about it. But here in the UK, despite Gordon Brown telling us that it was down to subprime lending, absolutely not, Governor. The Royal Bank of Scotland did buy ABN AMRO for £26 billion and did do a thoroughly bad job in the derivative market. But the problem was bad credit. We lent money indiscriminately to everybody as a result of need to build the balance sheets up, soft regulation agreed by both the Labour government and the opposition, full backing. And despite listening from time to time to Lord Mervyn King and also to Sir Paul Tucker at the Bank of England, who said this is looking a bit frothy to us, it fell on deaf ears. And that was what brought the UK credit situation down in the UK. But you could see, despite the fact the economy was trashed for the best part of a decade, you could see a recovery. With this, we have no idea whether we're in how long we're going to be in lockdown for, how badly it's going to trash the world's economy, and how quickly are we going to pick up, and why are we going to pick up, and how quickly can you get people vaccinated. And if people are out of work in their millions for a long period of time, how do you get them back? How do you motivate them? Where are you going to find the jobs? And all this, to me, is an imponderable. It's a huge cumulonimbus cloud. And whereby I salute Jay Powell, the chairman of the Federal Reserve, for throwing the kitchen sink at it to the tune of probably in excess of $3 trillion. And whatever the Bank of Japan and the Bank of England have done, the only disappointment to me at the moment is the European Central Bank, but we can come to that later. But this is very different because this is not something that is an economic problem or caused by poor economy. This is caused by a virus, which is a killer. And the reason why this is the worst for me ever is not because the stock market has fallen out of bed, because I think its recovery in the last month is even equally more amazing for reasons I simply don't understand. But the fact remains is no one can tell me what's going to happen in 6 months' time, whatever they think. No one can tell me, even some of the S&P 500 companies are trying to tell them, they're trying to work out their cash flows and their credits and their profitability for 2021. I wish I knew what was going to happen tomorrow.
So you do believe it's going to end up with the worst recession in history and it's going to be enduring?
It's going to take longer. I think what we've got today, which we didn't have in 1929, and I'm not trying to be supercilious and facetious, is we've got fantastic communication, we've got brilliant technology, and we've got amazing innovation. So I think the recession could be deeper, but I don't think it's going to go on through, as it did do from 1929, virtually through to the start of the Second World War. It was desperately depressing. And it did take forever because we didn't have the benefit or the value of any of those wonderful things that we've got today. But anybody who thinks that, we're going back to work on the 31st of May or whatever it is, and we rub our hands and say it's gung-ho, fixed bayonets and over the top, you're in cloud cuckoo land, as far as I'm concerned. I think it's going to be slowly catching monkey. And it's going to be very, very frustrating, very difficult, and a lot harder than people think.
So we do have the tech that you referred to, which is a sort of silver lining, but the market has been incredibly forgiving. What do you put that down to? Just all the fiscal stimuli?
Fiscal stimuli, misplaced positive thought on a drug being found and a vaccine being found. These things take much longer, and we know that. I mean, normal vaccine takes 5 years. If we get one to circulate around 100 million people, and how long is that going to take? Within 18 months, we've had a major result. And also, I think the fact that we have had a liquidity issue with the futures market, which has driven what's certain very, very influential traders within the marketplace has led us, based on the back that the Fed is there, the Bank of England's there, the Bank of Japan is there, the European Central Bank is there. They're just giving money to the banks to prop the economy up. It's not the same as the credit crisis. This is very different, because let's just say all 100 people who are listening to this, webinar, we're back to work on the end of June. Let's say most people are back to work at the end of June. Are you going to the pub? Are you going to go to a restaurant? Are you going to be allowed to go to a restaurant? Are you going to go on holiday? Are you going to fly? What sort of mental state are some people going to be in? Who hasn't got any money anymore because they've lost everything? How long is it going to take to motivate everybody to get back? It's not going to happen in 5 minutes. It's going to take miles longer than people think. These things just don't rectify themselves. I mean, I am the greatest optimist in life, but I can't see it. And that's why the pricing of the market, I got the 30% drop. It's painful when you're at my age and you're retiring, you want something to live off. It was every day looking at my computer, thinking, oh no, another 5%, oh no, another 10, so on as it was. But this rally that we've seen, which is the biggest rally any mature equity market has seen in 50 years, to see the S&P 500 13% up, the Dow 12%, and the NASDAQ 15% in 1 month. Okay, by the end of the day, I might be slightly wrong because it looks like a slightly negative day today. That to me is unrealistic and completely astounding. I listen to the Goldmans, I listen to the JP Morgans, I listen to the Bill Ackmans. They've all got track records far better than mine. They know loads more, and they know how to work markets. But this to me is completely illogical.
I mean, commentators would say that they're looking longer term into the future and they're just ignoring what's happening in the short term. Does that make sense?
Yeah, makes complete sense. As I say, people are looking. A lot of the component companies in the S&P 500 to work out plans, to work out cash flow, to work out profitability, sales and all that, and, P ratios going into 2021, as I say. They are geniuses or they're misleading us, one or the other. And because I think it's impossible to know when the greatest driver of the world's economy is people spending money. I mean, I'm no economist, but you don't need the brains of a rocket scientist to work that out. Is not that I'm not the brain of Britain, but the fact is, it's the service sector. If people aren't in the shopping malls, aren't going on holiday, aren't taking their wife, girlfriend, families out for lunch, dinner, or supper, then the economy is going to come to a grinding halt. And we know the economy is going to come to a grinding halt probably by the end of July, which is the end of the second quarter. But it's the pickup from then. How quick is it going to be? And how easily are we going to be able to do it? Now, we all know that the number of people who've been involved in technology and various other things and social media and that kind of thing have done extremely well. And the supermarkets, the Walmarts, the Targets, the Tesco's, all these sort of guys have done extremely well, not to lose much in value because everybody loves them. But it's the rest of the economy, and we've had not bad results from the going into the second week of the US earnings season, and it's all historical. There's nothing futuristic about this. And when we come to July, August, and September, and we start hearing some of the horrific stories we're going to hear some of these companies, chickens come home to roost. I hope, dear God, I hope I'm wrong, but I just think this market's got ahead of itself.
Yeah, I agree. GDP in America is forecast to be somewhere between minus 20 and 30% in quarter two, I think. Moving on, with all this fiscal stimuli and slashing interest rates and asset purchases and expanded lending facilities and furlough schemes and business grants or loans, how do you think this plays out? I mean, everything is much more than 2008. What happens? Do we get amazing inflation? Do we get stagflation? What are the downsides of all this money printing?
I think first and foremost, there was a lovely old film about 60 years old starring Charles Lawton called Hobson's Choice, and that's what it was. There is no alternative. Print money, expand quantitative easing, throw the book at it, give everybody the help from the man in the street to the banks, as much help as you possibly can. And we'll all have to rally round and take our share of the debt, which is still was horrendous before we even started this, and the support that we're going to have for each other for buying, whether it's US treasuries, gilts, all the European markets, Eurobonds, and the rest of it. We're just going to have to do it. And it's your generation, Tamsin, and your children and my grandchildren's generation who are going to have to pay for it. And I think it's going to be very painful. And I think the style of society will change irrevocably. And I think for now, that the result of this is that inflation will go down to 1% right across the world, if not lower, because as you say, it's deflationary and stagflation. And apart from things like flour and a few other commodities, these are all on the floor now. And there's nothing out there that ventures to suggest that in the next 2 years that is going to come up, because certainly interest rates are going to remain in the United States, I would have thought, at 0.1%. If they go up within 3 years, then I think that's fantastic. But I don't think it's going to happen. And the outlook, I think, is very, very, as you say, stagflation and deflationary. I don't see inflation being an issue at all in the next 2 years, because there's nothing that looks like it could really gather momentum in the next 6 months. People are saying, well, hang on a minute. Oil's gone up from whatever it was, naught or $11 for the June contract up to whatever it is, 17, 16, 17 now. That's, but these are unprecedented low levels that we haven't seen really since pre-2008.
And what are your views on the ECB stimulus and the Eurozone stability and their bank stability?
Well, I'm not really the most objective person to speak to, if I'm really honest, because I'm not a fan of the European Union. I'm a massive fan of Europe, and I'm not a fan of the ECB as it is now. But we need to be fair. I mean, I think Mario Draghi, who was an investment banker with Goldman's, and he was a brilliant central banker. And considering he's not a politician, I think he handled the ECB's affairs pretty well. I thought Europe, or the European Union, came in very late for quantitative easing, which I thought was a dangerous card to play. And Madame Lagarde, who's been there since November of last year, to me has proved an amazing disappointment. She's very different. She's a politician and a very good one. And she's a lawyer, and she's extremely personable, and she has, I'm told, an amazing ability to get other people to do good jobs for her. Now, all I can hope is that what's been thrown at the European economy, I mean, the way they let Italy down was disgraceful during their hour of need. And, you do see the European Union fragmenting for the moment. Maybe it's temporary. But what you can only hope is that what they've thrown, which I think so far is about €750 billion or €750 billion at the affair, where you're talking about 300 million people. And, I think it's wake up and smell the coffee job, because this isn't going to be anything like enough. What I do know is that she's a very good listener, and she's well advised. And because she's a good politician and she's highly regarded by the 26 members of the European Union, and, she's a good operator, I'm just hoping and praying that she'll come with a late rattle on the rails, to use a horse racing parlance, if you know what I mean, that she will suddenly come, onto the bit and realize that she's really got to throw the kitchen sink at it. But in her defense, trying to bring to heel or get 26 countries who've got their own personal agendas. I mean, we're all different, but the one thing I have noticed, as we all have in the last 6 months since this coronavirus started thing, is that nationalism is now very important. And the idea that the European Union, look, we're all great buddies, and, this is the way to do things. This is the way to stand up against China, Russia, and the United States. We all stick together. That theory at the moment is seriously in doubt, because, if you've got a major problem and you've got thousands of people dying in your own country every month, you're very interested in looking after them. And whatever might happen elsewhere is a bonus. And I salute Germany, who've worked hard to try and provide hospitalization and various other things for things. But at the end of the day, that's just scratching the surface. So to date, she is not showing us much on the gallops, if that makes sense to you, to your listeners. She's running on the gallops well within herself, and she's not putting her best foot forward. And I'm only hopeful that she realizes that the chips are down, and she will come, as I say, with a late rattle.
And with the Eurozone stability, do you think it's threatened by all of this?
Hugely. I think given a chance, Italy would be out of the European Union tomorrow. We know Greece would. We know neither can possibly afford to do it for the simple reason, because they're tied to the euro, that if they tried to bring back their own currency, they'd be destitute. I mean, it just couldn't happen. I think Spain is bordering on being extremely disappointed as well. And the only people who are smiling like Cheshire cats, of course, are Germany and France. But this has always been the case. And we saw signs of anxiety last year from Poland, from Hungary, and even the French. If you really, I mean, when Chirac said you got the wrong decision and forced them to go back to the polls to remain in the European Union, that was completely unprecedented. I'm very confident if you went to France tomorrow, and there was no pressure from Macron or anybody else, or from the other political people of that nature, they would vote to come out. I'm confident of it. I had an apartment, I had a flat there for 10 years. There's no real stomach for it.
And moving back to the UK, do you think the Bank of England's doing enough and our government are doing enough?
Yes, I do. I think, again, I'm a massive fan of Andrew Bailey's. I do know him a little bit. And I think that he got severely criticised after the banking crisis for the stress tests that the Bank of England, particularly him and also Mark Carney to a certain degree, and we all thought he was barking mad, interest rates at 6%, house prices falling 30%, this sort of thing, so that the banks could take it. And thank God he did. And I think and he still said, the stress tests never had a coronavirus in mind. It just had another banking crisis. So I think he's done a fantastic job. I think Rishi Sunak could be a really great chancellor. I think he's had one really damaging problem, and I don't know how to get round it, to be perfectly honest with you. Because I think if you're going to change the civil service, you need a mandate to be in government for 10 years, because it's such a political organisation. And I think the Treasury is incredibly well run. I think the Treasury is a great operation. But the problem is being logistics. It's all very well saying, right, there's 335 billion pounds to go out in loans and various other bits and pieces that people want, the job retention scheme, all these things are marvellous. But is this money ever going to get anywhere? Because you've got HMRC, which is, I'm sure, in terms of collecting tax and doing excise, and those are excellent. But when you're coming to dealing with about probably as many as 15 million people, do me a favour. You've got 5 major clearing banks. Half of them have got people sick, so some of the branches are running off 2 or 3 people. You've got supposedly 35 other institutions who are very small. We need to find a facility whereby this liquidity that is being provided in good faith gets out there. I mean, we've had this nonsense with, some of the banks, particularly Lloyds and Barclays, saying, we can't lend money to Fred Bogg because we don't think he can repay it. I'm sorry, we're not in that scene at the moment. We're in the scene of survival. And that's why the logistical side of this is proving such a horrific thing, that he's had to come back last week and offer 100% guarantee on certain parts of these small loans. Because in the United States, they've got 51 states. They've probably got 20 regional banks in each state. Easy peasy. So the Fed says, there you are, chaps. There's your 2 billion or whatever it is, or 20 billion, whatever it is for each state, and they get it out wallop. But we just don't have the ability to do that. And this is a serious wake-up call that we think about. We're pretty useful at technology. But to have HMRC as your main person to distribute the largesse and to organise it doesn't make any sense to me. It's nothing against them. They just don't have the wherewithal. And as regards the other banks in Europe, I think UK banks, and many of you will have noticed that they have all lost circa 40% since the beginning of the year in terms of share capital value. But just look at what's the other side of La Manche, for want of a better expression. Deutsche Bank, oh dear, I'm not so sure about that. And then you've got some of the Spanish banks who we hear have been somewhat, how can I put it, economical with the truth as regards what their bad debts might be. And I can't believe that the Italian banks are in great shape. And, when you look at the French economy is now minus 5.8 for the first quarter. How strong is Societe Generale, BNP Paribas, all these sort of people? They're all big names. But look at their share prices. They've been absolutely trashed. And I am worried about the European banking system. I don't think it's as well regulated as ours. And I just hope that one of the reasons why Madame Lagarde has been, how can I put it, rather ponderous in her approach is to work out how to get the money out to the folk and the businesses, bypassing the banks or just using them as a post office.
Doesn't that turn into grants rather than loans if the government are giving 100%?
Yeah, I think you're right. But I mean, I wouldn't be the first person on earth to tell you that the European, banking sector does look a little wobbly.
And you're suggesting that you could have another financial collapse, I suppose, if banks go under.
I think the ECB and the Bank of England and others know what the score is. They're not going to tell the general public at large. But that's why I'm hoping that, because the idea that the European Union has been so ponderous in its response to this incredible crisis really makes me scratch the back of my head. And I'm thinking that they're probably thinking about what is the best way of doing this.
Moving on.
I'm wrong.
I hope you're wrong. Moving back to sort of payback time, where do you think that's going to come in terms of taxes?
I don't think, as I say, I think a lot of people think nonsense when I've thrown this one out, but I'm going to throw it out anyway. I think people, if they don't think that the political map is going to be totally different in 4 years, then they need to dream on. I mean, Brexit, what's that all about? It's irrelevant now. Absolutely irrelevant to me. I hope it's done and all the rest of it. But in terms of the agenda, it's not top. Surviving is top. Now we've issued, or the world is going to issue all this paper in billions and trillions of dollars, yen, euros and sterling and so on and so forth. Someone's got to pay for it. And therefore, you hope that the economy will rally to the cause in the next 5 years, and there'll be enough corporation tax and enough income tax and various other things to make a dent in it. But the idea that we are not going to have to increase taxation right across the spectrum, I don't care what your politics are, and I've very much always been of the believer that low tax rates generate more business, and I'm absolutely certain. But as I said to you before, I'm not certain that the fresh high level of business can be generated quickly enough, if that makes sense to you. And therefore, in order to be able to make sure that we don't get our GDP to debt in areas which are just completely nonsensical, they're going to have to be more taxation, without a doubt.
And where's the low-hanging fruit to claim that, to get that?
Yeah. There's only one way that you can have decent public services: taxation and borrowing. There is no other way.
If taxes were so easy to come by, they'd have already put them in place. So where do you see them coming?
I think it's been as I said to you, Tamsin, I think it's been a political problem before. The Conservatives hate anything but low taxation. Labour, obviously, are massively supportive of the public sector, which is understandable. That's what their criteria is. I get it. Everybody is going to have to come round to the idea is that what we have experienced in 2020 is unprecedented. It has blown any kind of reasonable economic thoughts completely out of the window. You've now got to start with a new, fresh piece of white paper, work out what the debt is, work out what you think is going to be what level of taxation you think under the new regime that you're going to be able to raise. And by the new regime is, profitability is not going to be there right across the spectrum that it was before. And somebody has to pay for that. You can't just keep writing debt. You have to have higher taxation. And, whether it's corporation tax down from whatever it is now, 19%, and we're going to have to put it up to 25, so be it. If, there has to be some kind of surtax on people earning 500,000 a year plus, whether we graduate the 40% tax rate at a higher level. It all requires a huge amount of work, but it's all kept in the back burner now. Nobody wants to talk about it because it's reality. But I can't believe that if you and I had a conversation here in a year's time, that some kind of increased level of taxation, and I'm no expert, has to be implemented. It must be.
Yeah. And topical today, Shell cutting their dividend. When do you see dividends returning from all the income-paying companies or dividend-paying companies?
I don't think you can say something across the board, but, the banks have more or less played ball, courtesy of the Bank of England and the Treasury. Most of the large insurance companies are not going to pay any dividends, which is very sensible, even though they've got most of their businesses not really around insurance, it's more through managed funds. You've had a lot of other companies come up. We had Carphone Warehouse yesterday. Shares bounced by 11% when the news was they wasn't going to pay it. Shell and BP are incredibly important because the two of them have been easily the biggest provider of dividends in the FTSE 100. And this is the first time that Shell won't have paid a dividend since 1940. And I think last year, I'm right in saying they paid £3.8 billion in dividends to various fund managers and retail investors. It's been amazingly important. And BP, over a period of 20 years, and since the Horizon disaster, whenever it was in 2010, was an even bigger payer of dividends. So, to answer the question, 2 years? I can't see it. I'm not saying right across the board, but generalizing to get back to the level of dividends that we've been receiving, I think it's going to be 2 years.
And what's the impact for pension funds in the meantime?
Well, what's the retiring age now? 66? I think it might be 75. I mean, people are now, and this is the other really worrying thing, is that as a nation, we're not great savers. Most of us do what we can for the pensions, but in the private sector, it's pretty small. In the public sector, an awful lot of people rely on OAP. And the idea that people are going to be able to cope for the rest of their lives. I mean, 2/3 of salary on retirement, dream on, that's got to go. And I think people seriously now, where they can, have got to try and save. But the way things are for most people, that's impossible, particularly when they're, 5 million people, probably maybe 10 million people are going to be severely affected by what has happened in the last 3 months. And for them to even get or think like they're going to have to postpone their mortgage payments, postpone their bank loan repayments, probably stop spending any money at all apart from eating, to ask them to think about spending in this climate is ridiculous. And that's another reason why I think whatever these gurus say that, our markets are now correctly priced for a recovery. As a pensioner, I am delighted, but I don't believe it.
Interesting. So if you had 100,000 to invest today, would you put any of it into the market as we sit here today?
I would put some, but it would be almost certainly based in work that I'd done or people had done for me in the world of technology and biotech. Obviously, with things like vaccines being very important, I'm very interested in the small biotechs, and I would probably have 4 or 5 lots of £5,000, say, in ones that I thought really offered, some fun. Well, I don't mean fun, some realistic opportunities of making some money. Apart from that, I think because we're going to be sort of in an area where we just simply don't know what's going to happen, the big US techs also interest me. I still think there's more mileage in the likes of Microsoft, more mileage probably in the likes of Apple. I think Apple's going to have a problem though. And that is that a lot of people are so angry with China. Are they going to buy, an iPhone again that's made in China? That sounds rather frivolous from me, but I've heard it in more than one bar and coffee shop in recent months. People are very cross. And I imagine Tim Cook's a lot more smarter than I am, and he probably knows exactly what he's going to do. But the rest of it, do you know what? I just don't understand it. So I probably buy the fag end of the gilt market or a really top-notch commercial paper with 6 months to run or a year to run, because do you know what? I haven't got a clue.
So what, you'd be about 50% invested by that stage of your 100,000, right?
Yeah, maximum.
And then
also probably very nervously and not sleeping very well either.
And what signs would you be looking for? What would tell you that it's now a good time to move to 100% invested? Would it be GDP figures? Would it be PMI figures? What would you be looking for?
I'd be looking, to be honest with you, to go to Covent Garden and not be able to move because of the people. And that would be the best barometer I could possibly have, that people's Adam's apples weren't moving as they jugged it down, that they were smiling, they were laughing, they were talking about their girlfriend, talking about what they'd bought her for a birthday, talked about their mum and dad taking them on holiday. That's where it's at. When we're spending money and when people are having a good time and doing it regularly, that's a far better barometer than people burbling at me PMI, ISMs, GDPs and the rest of it, because we'll know very quickly that when that really starts to buzz, the show's back on the road.
Great. And on that happy note, I'm going to open it up for questions. Dave Sullivan, let's go to you.
Just wondering what your view on gold and gold miners were?
Basically, I think, to be honest with you, it's a professionals market. And to be honest with you, in lieu of what's happened in the last 3 months, I've really struggled to work out why it's taken so long to get up to $17.27 an ounce, because I thought we'd be through $2,000 an ounce. I think it's a professionals market, and I can understand people feeling the flight to quality. I don't want to go into the bond market because it's on the floor. There's no yield for me. There's nothing for savers. And I understand people have reluctance for equities, and most people want some liquid assets, so they won't probably want to go and buy a painting or something, or, some claret that's been laid down in Bordeaux that you're going to make money on, because there's no liquidity in that. So gold is an obvious place for flight to quality. My only thoughts is that there are so many imponderables about it, into the degree that what we use it as an asset to invest in against industrial activity. And if industrial activity isn't there, then you can understand, if you understand what I mean, that the price isn't really going up. So to say, do I have a strong view on gold? The answer is absolutely not, because, as I say, unless you know the underlying market of what's going on, as it being mined as a physical, how much, whether, the Indian State Bank is going to buy so many bars or some other central bank is going to do it, it remains a really, it's like a dark pool. And so if you ask me where I think the price is going, I'll just say in the next 6 months, I'd be quite surprised if it's not at $2,000 an ounce. But do I have a long-term view on it, or do I understand it as an asset? No.
So we've got a question that's been typed in by Ian George. And Ian says, David, a great thought-provoking seminar. Before I go for a lie down, I'd like to hear your thoughts on the likelihood that one of the first places the UK and other governments around the world would look for increasing tax take is the large US tech companies.
There again, it's a question of balance. I've always felt that if people are going to stop tax avoidance, which is legal, then you have to have a common policy in every country around the world. Otherwise, it's not going to work. Now, why do I say that? Is that because people have gone nationalistic, which I was discussing with Tamsin a few minutes ago, they're obviously going to look after their own issues. Like, let me just give you an example. I mean, I was desperate for Greece to leave the European Union 5 years ago, whatever it was. I thought, well, there's 11 million people. There's a climate which is beyond anybody could ever want. Fabulous for holidays. Bring back the drachma. Devalue it by 40%. Say hi to Apple, hi to Google, hi to Microsoft. Come and set up your shop here in the Piraeus, and we charge you 5% tax. It would have made huge sense, apart from the fact that Greece couldn't get out of jail because of its holding in euros, and therefore their banking sector would have been trashed. The problem is that people, if they feel that they're vulnerable and they need to get business, they will always use a level of taxation to entice people to come and do business. And where I think, we would see the boundaries more sensibly done is that if the United Nations and people like that, the World Bank and international institutions who've got the world's best interests at heart, were saying, listen, we've got to have a moratorium on taxation, that everybody charges exactly the same, then your idea of implementing serious taxation on people like Amazon, Apple, Microsoft, and all these sort of people, it is ridiculous the level of taxation they pay when they, are doing incredibly well and use places like Liechtenstein and Luxembourg, as their head office, for that reason. But I always think that because if it may suit somebody to offer somebody, I mean, look at Ireland. Ireland offered Apple, a really good deal to come over and make their stuff and put it around. And now they've been fined 12 billion euros by the European Union. It just shows that people, and they don't see why they should pay it, and I don't see why they should either. And this is one of the reasons why I'm uncomfortable with the fact that I don't have the right answer. The right answer is everybody charges the same rate of tax, these people, and then therefore there's no getting out of jail.
We'll move over now to Robin Maxwell.
I'm sort of sympathising with just about everything you've said on this call. I also share your view that it's very difficult to understand exactly why the market is bordering on complacency. But I'm interested in your views on interest rates and how that's impacting the equity markets, because if there's one thing that really has changed since 2008, it's that there is no return on cash. There's no return on government bonds anymore, probably at all. So is that not one of the situations that is very different this time around, that we do actually have three significant pockets of liquidity in the world: tech, healthcare, in particular, and food, which are all doing quite well. And there's no return anywhere else. So it's just keeping money in equities. Is that a fair assessment?
I think it's first class, Robin. I can't argue with any of it. The interest rates, in my humble opinion, cannot go anywhere for at least 2 years and probably 3 years, because we had our chance to wean ourselves back into what I call the commercial world in probably 2012, and we didn't take that opportunity. And now, of course, if there was any increase in the level of interest rates, industry, business and commerce would just fall over. They wouldn't be able to service debt, let alone repay it. And it would be just a hopeless commodity. And in order to be able to get people's debt out, which is going to be of fundamental importance, whatever the coupon is at the moment is irrelevant, because as long as China, unless the United States gets really difficult with China, buys billions of dollars worth of, or trillions of dollars worth of treasuries, and they do the same with renminbi, and people buy gilts and people buy euro-related bonds, that's great. But once we're into a survival mode now, we're not into sort of manipulating the economy to get greater growth yet. I think that'll be the case in 6 months to a year's time. But now it's just full on survival. Your assessment of where it's right to put money, I think, is absolutely spot on. And I don't think the likelihood of that changing, that agenda changing in the next 6 months to a year is a possibility. Certainly interest rates, you can forget it, because so many world governments have got to get this debt out. And they've got to get it out, whereas they're not taking each other on, unless, of course, they are very small countries which are bad credit risk. But I'm talking about the United States, Japan, the European Union, Great Britain, and that's where I think the main debt is going to be issued. I mean, India is a little bit of an anomaly. We don't really know. I mean, it's an enormous economy, but people still are hugely reluctant to buy their debt.
And I've got one secondary question, and that's just your view on the virus, really. I mean, it does seem that you can read an awful lot of statements of fact from history which suggest that there's a real risk of a second wave. Why do you think that equity markets are so complacent in not discounting that risk?
Well, again, I can't argue with the content. I've had a couple, as I'm sure many of you have had it, but I've had a conversation with people who work in Wall Street. And my last one was about 3 weeks ago, when this pop in the market started to go up again, about the 10th of April, this was just about Easter. I had this conversation and I said, what is going on here? And he just said, you don't get it, David. And I said, what do you mean I don't get it? He said, we are going back to work at the end of May, beginning of June. Fact. I said, what? He said, the United States of America is like this. You look at New York, Baltimore, Philadelphia, then you go across to New Orleans, Chicago, St. Louis, and San Francisco, San Diego, and San Francisco. And then it's a great sea of country and small businesses. And they're all saying, you know what? I'm going to try a bogus American accent. Mom and Dad, and the two of us, Gramps, really sorry, you're 75, old pal. We wish you well, but you've had your life, we haven't. And that's their attitude. And that's why I think people genuinely think, we've listened to you. We know it's right that we shouldn't go out for this time being. But at the end of the day, we just can't just watch. I mean, if you and I are having this conversation, Robin, in September, and we haven't gone back to work, God help us.
And we're moving over now to a question from James Morton, who says, hi, David, great analysis. Be interested in your views on UK property prices, particularly in London, over the next 12 months.
Interesting one. Again, not my strong forte. I live in the People's Republic of Hammersmith and Fulham, and we've seen property prices in the last 3 years here come down about 15%. But I think we are basically a reaction to many supposed French bankers, German, Danish, Italian, going back to their own homes because they don't like Brexit. And a lot of housing has been on the market down here. And there again, the government has vented its spleen on the Russian oligarchs in the centre of London. And that has seen properties really come down very heavily at the high end of the market, and also the stamp duty situation. But for what I call human beings who have properties in London between, shall I put it, 500,000 and 1 million, I think the market in 3 months' time could come back quite buoyant. As for commercial property, I have my doubts, and let me tell you why. One thing we've learnt in the last 2 months, James, is that we can work from home. So the idea that you need a very smart West 1, SW1, SW3 property, thousands and thousands of square feet with lots and lots of people, clerks, analysts, and what, you don't need it, because this all the stuff can be done from home. Yes, you need an office, and yes, you need a boardroom. Yes, you need the CFO and the various managements and the directors. But that will means that as things evolve in the next 6 months to a year, they will be able to cope with a much smaller area. So when it comes to renegotiation and some of these huge buildings that are going up in London all the time, I don't have a problem with it, because people just don't need that kind of space, because it's been proven that with technology being absolutely wizard and people have learnt to work very adequately and get their job done in their own time, I think this is going to filter through. And I think you'll find that the modules that people have in their offices come down by a significant level. So I wouldn't be a bull of commercial property in the centre of London in the course of the next year.
What about property over 1 million, residential?
I know, I'm just pausing for thought. The answer is I don't really know. But what I'm thinking is that really basically we need to know whether there is a big recovery in the economy. Because most people, if you're saying, well, I wanted to move, I don't look at this now. There may be, because you just, the imponderables and the unknowns out there could just bring that level, the 1 million to 5 million, say, under considerable duress. And you can say, well, hang on, these guys have already got money. Yeah, they've got money at the moment. But on the other side of the coin, I mean, if you just look at HSBC, for instance, say hypothetically, They are going to get rid of 35,000 people in the next 3 years. Now, many of those are not going to be in London. Most of those are not going to be in London. But that kind of attitude is going to take place and is going to be more prevalent. I talked about nationalism. And, people will say, we don't need to have such a huge presence in London that we've had before. I still say that London is the greatest financial centre in the world for financial foreign trade and for IPOs and for business and for foreign exchange. Everybody knows that. But the number of people that we've seen go from Deutsche Bank, well, we understand that about 6,000 people have gone, and Credit Suisse, UBS, they're all letting people go. And this is where the barometer, in my humble opinion, of central London property comes from. And if they're not around, I wouldn't be in a position to think that that would be the most buoyant of property levels. I could be wrong, but I think what we're talking about now is the next 6 months. And I just think it's going to be incredibly difficult. Longer than 6 months, we'll have to see.
We've got a question from Martin McLeod that says, David, you said you expect a much deeper, possibly sharper recession. Does that mean you expect a recovery or market lows to begin end of this year, start of 21?
I think before we see a real adjustment in equity market situations is that we're going to have to see the whites of the eyes of some of the second quarter earnings. Because the ones we've been getting now, I think, are slightly misleading. A lot of people have been saying, the outlook doesn't look good and the rest of it, but people just seem to want to inhale the good news, I think is the right way of putting it. So if we are going to see an adjustment, I think it's likely to be July, August and September. And then I think if things don't manifest themselves to the degree that a V-shaped recovery is on its way, valuations will sort themselves out, because if people can see that the projected profits are not there, and they can't be there because the economy is not there, then natural courses will be made, and it won't need people to start shorting stocks because they think they're too high. That'll be a contributing force, but people will just realize that the valuations are not there. I mean, it is possible. But I think very unlikely that those people who set the stall down and dominated the agenda during the course of the last month have seen this incredible 12 to 13% rally across the spectrum have got it right. And I salute them if that's true. I just don't believe it. I'm not buying it. I need an awful lot more evidence. And I can't see it from an economic point of view, and I can't see it from a trading point of view. Because I think the other thing that we haven't discussed, which I think is incredibly important, is the economy is not going to pick up unless two things happen. People can move around, i.e. fly, and also goods are coming thick and fast, both ways, from China or the Far East to Europe, to the United States, and back again. And that doesn't even look like starting to happen. It was interesting to say that somebody was saying this morning about China that the prospects for industrial production and manufacturing output and exporting were looking really good. But the Chinese were struggling to get some of their goods away. I bet they are. People haven't got any money. And people aren't buying anything because they can't. What's the point of buying something if it's not being shipped? Because it can't be. And this is where I think you've got what I call the oil tanker syndrome. It takes an awful long time to get from A to B. You don't just turn it like you twiddle on a sixpence. It takes time. And I think people saying, oh, well, China's over the worst, they'll be on their bike and they'll be cracking on and, stuff will be arriving in the UK. Because, you look down at the wall of my little room here now, and all those plastic plugs and things, they're all made in China. And, that sort of stuff, if it's not getting through, the builders can't do their stuff, and it's just a domino effect.
So I've got a question now from David Kempton, who says, firstly, thank you very much for your founder recommendation in Weekly Fare, which I very much enjoy reading. Please keep them coming. We have plenty of watching time. Can I ask about either a fund suggestion or a comment? In difficult and very volatile markets such as we have now, most of us have neither the concentration or commitment to follow the twists and turns through even a day, so would resort to collective funds where a manager can watch it for us. It also enables us to focus on a country or region. Can I ask which particular region you'd favour now? China, Asia, Japan, or any particular fund?
Well, in January, without doubt, it would have been Japan. I have no doubt at all about that, because the incestuous relationship with all the companies had with each other, boning chunks of stock of each other's companies, was ridiculous. But regulation in Japan has improved. I worked there, so I know a little bit about the country. And the regulation has improved beyond all recognition. It's a really sound place to invest now. And also, the Rugby World Cup was a massive success. And again, I'm going back to it, boring you to death, by talking about retail, people enjoying themselves, having a drink, buying seats to go to rugby, having a wonderful time, having a holiday. And then, of course, the Olympics was the icing on the cake. No Olympics yet. Maybe it'll happen next year. So I wouldn't binge Japan. I'd keep it there. But I suppose on a purely recovery basis, has to be the United States, because they want it more than anyone else. And they're ruthless,
And David Edwards asks, do you think regional online taxes for sort of Facebook or Amazon would now be acceptable to the USA?
Again, it's one of these equalization things, isn't it? Unless it's done across the board. Okay, if they do it in the United States, I don't think President Trump's going to start it now. But, if anybody messes with President Trump, not through logic, he's going to mess you back. And so any difference of opinion there is between France and the United States, I know who my money's going to be on. But I don't think that's a very constructive thing to say. Is what I'd like to see is it takes a crisis like this for people to settle down and look very closely at what I call a purely international level of what people can do as each individual country to try and make the recovery more aggressive and less painful than it might be for the whole world. And I think that's the only thing I can say, really. But I can just see in the back of my mind, the Star-Spangled Banner, I'd almost hum it to you, except I'd embarrass myself and you. And it's the same with, Le Marseillaise or God Save the Queen. And nationalism is stronger now than it's ever been, and it ain't going away.
It's a lovely point to end on. Thank you very much indeed, David. I'm afraid that's all we've got time for.
Lovely. Lovely to chat.
Oh, can you tell our audience where they can find you?
Well, you can find me on Twitter at TrueMagic68. It's the best way to find me. And I always post my weekly thoughts on a thing called Weekly Fare, which I've been doing for 20 years. If you want to learn anything, don't read it. If you want a good laugh or to get angry, you'll love it.
And a bit of poetry too, I believe.
Yeah, I always put a poem. It normally reflects my mood or the market's mood. This is more to the point, really.
Oh, David, many, many thanks indeed.
Great pleasure. Lovely to chat to you all.
If you want an email notification of company meetings or webinars that PI World are organising, please sign up for events, which is on the right-hand side of the homepage. And there are two boxes, one to sign up for notifications of publications of a new video, and the second one down is sign up for events. They're different lists and there's no spam. And do tell your investing friends about PI World and write comments or like our videos on Twitter, bulletin boards and YouTube. We'd like to go on providing these free webinars, and getting really good speakers like David relies on the audience numbers we attract. Many thanks to you all for joining us, and stay well.